It actually gives me only $5 million of NPV, and that's in the yellow zone. So if things go bad, the NPV may even turn out to be negative, right? But next year, I need to make a decision. I could either stay with the project, let it run its, there's a little bug over there, let it run its course, or decide maybe I'm better off to close the shop. I spent all that money, but if I scrap it early in the project, I'm going to get a lot of more salvage value. And if I'm losing money in the future, I don't have to even lose that money. So maybe it's better for me to abandon the project. Similarly, it could turn out that next year, I thought it was going to be 105. Maybe I'm going to sell 120, and my existing sales are not going to drop that much. So I actually have the option maybe to expand the project in that case, if your project allows that sort of flexibility. Then we kind of need to build decision trees. Okay, there are certain percentages to these eventualities. We're going to basically calculate what we call an expected NPV, given that we make decisions after uncertainties are resolved. That's what Chapter 7 is kind of mostly about. But there is one more thing we need to think about. That's inflation, how to handle inflation. There are two ways of doing it. One is the easy way. The second is the difficult way. One is you're going to basically build into your forecast expected inflation. I expect inflation to be 10 next year, 15 after that, yada, yada, yada. And use your discount rate as a kind of nominal discount rate. Or express everything in real terms, assuming inflation would be zero, what would have been your sales, and use a real discount rate. I kind of tend to use the second one. And we have kind of a quick and easy way of handling that. We have this fundamental equation that relates nominal and real rates. 1 plus nominal is 1 plus real times 1 plus inflation, which means you can write inflation rate as 1 plus nominal divided by 1 plus real minus 1. Let's first build a little thing. Let's call this EAC and 1 plus nominal divided by 1 plus real minus 1. Of course, I set this up so that it is 0. But if this is 15 and 10, that would have been the number. The difference is not 5. That's kind of a quick and dirty approximate number, but that's not the exact inflation you get. In this day and age, you don't have to worry about it. I mean, unless you're stranded on an island and you have nothing but a volleyball to keep you company, and you want to make calculations, you can take the approximation. But we have computers, we're civilized, we can actually calculate them ourselves. And we can get those numbers from market instruments. We have the treasury bonds, right? Currently, the yield on 10 years US Treasuries is 4.13 or so. But a lot of you may not know, which we're going to cover in more detail in Chapter 8 after the first midterm or after the fall break, uh, that are bonds that protect you against future inflation. These are literally called Treasury Inflation Protected Securities. They are affectionately known as TIPS, and you have federal taxes on these TIPS. And their yield is the real yields. So let's do the 5 years. 5 years nominal rate is 3.686. I just need to know on CNBC, if you search for tips, let me see. Now let's do, come on, US 5 years. Current rate on 5-year tips is 119. That means it yields 1.19% over and above the inflation rate. Okay. It does that by adjusting the interest and the principal payments of the bond. We view that inflation rate as kind of, some people think of it as expected inflation rate. That's not a forecast. What that number is, that's the break-even rates, break-even inflation rate. That's going to make you indifferent between nominal or real bonds. If you think inflation is going to be, let's say, 3% over the next 5 years on average, you should buy the tips. Why? Because it's going to give you 119 plus 3, approximately speaking. Okay. But the nominal is just going to give you 368. If you think inflation is going to be less, let's say 2, which is less than the break-even rate, you should go for the nominal bonds. So that's kind of a break-even rate. Let's see what the implied number for 10-year is. In fact, let's do this 5 years. I'm just going to copy these for now. US 10 years, 4.126 and 1.728. So market thinks that inflation, the average inflation is going to be a little bit lower over the next 10 years. which also tells you that market expects lower inflation in the second 5-year period, which is also something we can calculate, which I'm not going to do for this chapter, but we're going to actually work on that on chapter 8. In fact, there is a series Fed keeps track of. It's called 5-year inflation, 5-year break-even inflation, 5-year forward. Maybe we can do this for 30 years as well. Don't view these as necessarily forecasts. 4737, 247. So our that's kind of what market is kind of banking on. Let's stop here. If you're not already done with your chapter 3 homework assignment, if you guys want, you can have until end of day tomorrow, since I'm going to post your chapter 5, 6 tomorrow afternoon anyway. So if you want to spend more time on it, you could. Some of you have already shared it with me or submitted to me. You can email it to me or you can share your file on the Google folder with me. Either way is fine. I just don't want your classmates to see it. And I'll grade them this weekend and post everything over there.